Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by a bunch of colleagues, my two trusty co-hosts, Marissa DiNatale and Chris Dries. Hi, guys.
Hey, Mark.
Hi, Mark.
You guys look chipper. Have I ever used that word to describe you guys before? Chipper? I don't think so.
I don't
No.
think so. I
Years.
think that's a podcast new.
It's a podcast new. You're chipper. You're chipper. You look chipper.
All right.
And we got Mr. Collier.
How's it going, everybody?
Actually, he talk about chipper. Look at that guy.
Man.
You got a great
Movie star
CGI.
quality, man. What the heck?
Oh yeah, thanks.
No, I'm not kidding.
It's the warm weather, I think, is bringing everybody, lifting everybody up in this part of Pennsylvania.
Oh, is it warm up in PA?
Yeah.
Oh, cool.
60s. So
Mercy, you have anything to say?
Nothing. Not anything.
And we have a colleague, Firas Saleh. I'm sorry, Firas, I just butchered your last name, but good to have you on.
Thanks, Mark and team, for having me on your podcast. Very excited.
It's a form of endearment if I mess up your name. Everyone knows that because I'm like getting into big trouble. We have now invested in, and I want to see what's happened to this, but we invested in, on Zoom, or I think we're on Zoom or Teams. You can see person's name underneath. You can also get the phonetic pronunciation written for you, but you have to pay an extra fee, apparently.
Okay.
Uh,
That's good to know.
You didn't know that?
No.
Yeah.
You didn't have to pay an extra fee.
Yeah, we pay. Didn't we pay extra for it? I
No.
thought we did.
I don't think
Oh,
so.
someone told me we had to pay extra for it. No, it's free.
It's
It's
free.
part of the service.
It
Oh,
is.
Did you pay extra? Oh, gosh.
I don't know. Well, that brings up a whole nother set of issues. I pay for all kinds of stuff. I have like, what the heck is this I'm paying for? Anyway, I won't go down that path. But Faraz, you're with you are obviously a Moody's colleague, but you came to Moody's via RMS, which is obviously the large. I think of you as a large insurance analytics firm. Is that the way you guys describe?
Yeah, we essentially enable insurance, reinsurance companies to make more informed decisions using our models and data and our insights. So that's a sort of, what RMS, RMS has pioneered, I would say, the catastrophe modeling industry 35 years ago with earthquake models, and eventually expanded with other perils such as wind or hurricane, and then expanded to flood, earthquake, wildfire, with the advances in computational resources and with the risk landscape continually evolving.
Right. And you lead the way on floods and wildfires. Is that correct? Yeah.
And that's correct for the
Yeah.
North America region. Yeah.
Oh, for North America. Oh, I see.
Yeah.
And Moody's purchased RMS, what? Was it before the pandemic? No, it was after.
It was after the pandemic.
Yeah.
Yeah.
So it's very
Actually, they closed on my birthday. I was very excited.
Ah, is that real? I guess I guess that would be exciting. Yeah.
Yeah.
And we were talking before we got on the podcast. You've had a pretty interesting story to where you are today. You want to give us a sense of that?
Yeah, sure. So moved to the US in 2013. It was just after Hurricane Sandy.
You see how he does it? All his life is based on events.
Punctuated
Yeah,
by
exactly.
Catastrophic events.
It's catastrophic events that are
Yeah.
shaping my life.
You can tell.
Yeah. So, well, I came to the US in 2011 on vacation to see my family, and Hurricane Irene hit. Right. So that was, if you guys remember, August 20.
No, we don't.
It was August
Faraz, I'm
27th
telling you,
for me. It was horrible. Yeah.
we don't remember that stuff, Faraz. No.
Yeah.
We're,
It
we're
was a
weird,
lot of
but we're not that weird. We're not that weird. You are really weird. But
Yeah,
go ahead.
because it coincided with my vacation. That's why I remember it.
Oh, see? Right. Yeah, of course. Yeah.
So anyhow, that was the 2011 vacation. So we decided to come back, I would say, towards the end of the hurricane season. So we came back, I would say, end of October,
Uh-huh.
2012, the following year. And within a week or so, Hurricane Sandy hit New York. Like, so that's
Yeah.
so yeah. Back then, my wife said, "You must know something I don't know. Like every time you go somewhere, there's like either a hurricane or a flood." So that's my story a little bit with Sandy and Irene. And then I moved to the US in 2013. A few months after that, worked in New Jersey Institute of Technology and then Stevens Institute of Technology. And most of my work actually was focused on Irene and Sandy, right? Because there was a lot of funding from these events, right? On trying to better understand the risk, how that evolved, enhance forecasts, understand the element of environmental impacts, what mitigation we can do, and so on. So, at the time when I was during my vacation complaining about it, and then eventually it became what I focus on, right? My background is in
So well,
water
I was
research.
gonna, we were talking about Stevens. Most
Yeah,
people, Stevens is a wonderful university
yeah,
in Hoboken, just across the Hudson from Manhattan. And you have these beautiful views. And I was recounting before we got on, one of my friends from high school went to Stevens and said, "Hey, come on up and spend the weekend." And we saw Harry Chapin speak at this. It was a university venue, very small,
yep,
kind of like, I don't know, maybe 50, 60 people. And it was just, you can see, I still remember it because I could see Harry Chapin in front of me. And that Cats in the Cradle, right? Is that right, Matt? Cats in the Cradle?
Yeah, that's right.
Yeah, right. For all you young people who know nothing about anything that's important, like Harry Chapin. You know Matt, though. You know Matt.
Yeah, I do.
Yeah.
He's good.
So, off to the right is this beautiful view of Manhattan in the middle of the night. It's just a gorgeous thing. And
yeah.
apparently, I didn't realize this, but RMS has an office now. Moody's RMS has an office in Hoboken, looking at.
Yeah, we have a beautiful office on the waterfront. We can see actually the Moody's office from there. We can see the
Ah,
WTT from the Hoboken.
yeah, yeah.
Yeah.
Well, it's good to have you aboard. And you were also saying you are of Iraqi. It's Iraqi background, right? I mean,
That's correct.
yeah,
My family, my parents, are from Baghdad originally. But
Baghdad.
was born in France, in Paris. Yeah, and
Cool. So, did you speak Arabic?
I speak Arabic. Yeah, yeah, yeah. I speak
And,
Arabic, French, and English. Yeah.
oh, I'm so jealous. I'm so jealous.
Yeah,
It's
so we
amazing.
switch like at home. It feels like the United Nations because my
Yeah.
wife which Arabic, the kids would respond in English. I speak French, they still respond in English. So it's
Oh, so
an
cool.
interesting dynamic.
And which of the three languages do you like the best? I'm just curious.
I like, I like a lot the French language
The
because
French,
there's
yeah.
different ways you can express,
Yeah.
and there's the element of, if I know you very well, then the discussion is very different than it's a formal discussion.
Right.
So
Right.
all these different elements, I would say. Yeah.
Yeah. And you and Chris have done a lot of work together, right? I mean, you've been writing a bunch of articles, right, Chris? What do you guys have worked on? So just to give the listener a sense of the kind of things you guys are working on, because obviously we're going to talk about, what's going on with regard to climate, what that means for insurance markets, for homeowners insurance, for the economy. That's where we're headed here. But before we do that, you want to describe a couple of the things you guys have been working on, Chris?
Sure. So we've written a couple of articles for the Global Association of Risk Professionals, GARP. We have a monthly column that we do with them as part of our economic analysis and kind of focus on risk management. And so in December, we wrote an article on flooding and some concerns about the National Flood Insurance Program and how that's underfunded and perhaps not assessing risk properly in terms of the premiums that are being charged. And then more recently, just this month, we released a piece on the wildfires, wildfire risk in general. So we did touch on California's wildfires, but the piece was a bit broader than that. And for us, kind of opened my eyes to a couple of really interesting risks related to wildfires, or just the extent of wildfire risk. It's not just a California Western United States issue. The Northeast, for example, has had a number of wildfires, and we have wildfire risk in Japan and Russia, Australia. So it's much more widespread than certainly I thought. And so it was like I said, a really eye-opening piece, and just the impact on individuals can be direct, of course, if you lose your house to wildfire, but lots of indirect impacts as well in terms of insurance premiums and just the reassessment of the risk that we're seeing across the country.
Yeah, just to quickly link it back to the economy, we got the Consumer Price Index for CPI for the month of February today. We're recording the podcast a bit earlier. This is a Wednesday afternoon Eastern time. We generally do this on a Friday, but just because of travel schedules, we're a little bit early. But we have the CPI. Matt, we've been getting some pretty large increases. I know in motor vehicle insurance. Uh, can you look at, can you see homeowners insurance as well? Is that broken out in the CPI? I think it is.
I think it is too, but I don't have anything offhand if you give me a minute.
Okay. Well,
It's in there with renters insurance. Yeah. Broken out separately.
oh, it's there.
Yeah.
Okay. Well, we'll come back to that. We'll come back to that. But, you know, Faraz, this has clearly come to the fore, given all the seeming climate events, the most recent obviously being the disastrous wildfires in Southern California. And this past summer, previous summer, we had a bunch of pretty bad storms and that hit Florida that's having an impact. Is it just perception that these storms are more frequent, these disasters are more frequent and more costly, or is that really what's going on? Are they more frequent? Are they more costly?
They, yeah, it depends on the peril, right? So what we're seeing is we're seeing, for example, in the context of wildfire, right? So 10 years ago, when we talked to the industry about wildfire, the general feedback is, oh, this is a peril that is manageable. This is a peril that, when we were looking for feedback, oh, do we need to build a full, blown probabilistic model to understand the risk? We were told, well, this is more of an attritional peril. So we collected data, Mark and team, over 60 years of insured loss for the industry.
Hmm.
Insured loss meaning how much did the insurance companies pay for wildfire as a peril, right? And when you look at the numbers, it's quite interesting. It really looks like a hockey stick shape, if you will, right? So from 1964 until all the way to 2010, we had almost only $1 billion in terms of losses, right? And this is trended, right? And then the last 12, 13 years, we had 45 major wildfire events. So this essentially cost the industry about 75 billion US dollars, just to put that in perspective, right? And this was before what we just saw with the LA County wildfires, right? So when you stack it up, you basically see that trend, right? So one thing that the model development team was trying to, understand and model is, well, are we seeing a climate change signal? Is this climate variability? What are the different factors that are leading really to this escalation in the hazard and the risk, right? Now, when you put the insured losses for California recent fires, right, you're talking about, at least based on our Moody's RMS insured loss estimate, could be up to 30 billion, right? So this would be the biggest event compared to the Camp Fire and what we had in 2018 and so on.
This event in Southern California is close to 30 billion in insured losses.
Insured loss only, yeah.
Right. And in terms, which is only part of the loss, right? Because it's not all insured.
That's correct. It's only part of the loss. We look at the residential, commercial, and auto, right? So these are the three, I would say components that we look at. We don't look into, for example, the cost to the infrastructure, pipes, contamination. That's kind of like, yeah.
Do we have a sense of the total loss, including the uninsured loss? I mean, has anyone come up with a reasonable estimate for that? I know that's tricky. We try to do that.
Yeah,
Right.
it's tricky. We've not seen, we've seen a lot of estimates floating early on, right? But we've
Right.
been mainly focused, I would say, on the
The insured loss.
Yeah,
Right.
yeah.
And with the hurricanes as well, are they more frequent and more damaging? Is that the
We're,
reality?
yeah. I mean, that's a great question. We're seeing an uptick in the frequency, right?
We are.
Especially in
Okay.
the area of Gulf of Mexico, right? We had
Right.
Helene, and then following that we had Milton, right? And then 2 years before that we had Ian. So there's all these, like, extreme, I would say, hurricanes that are happening in some of these regions in Florida. We had Louisiana. We had if you remember, we had Ida just after COVID.
Mhm.
So we had a lot of flooding in New York and New Jersey, even though it made landfall in Louisiana, right? So there's this element of I would say the wet getting wetter, right? Because when you have an increase in temperatures, right? It basically means more water moisture when it comes to rainfall, right? So the extremes are becoming more extremes, and droughts are becoming also more extreme. So that's sort of a little bit on in terms of how the climate is evolving.
So the storms are and the fires, the natural events seem to be coming more frequently, and the damage is more serious. Uh, the other perception that at least I have is that this is starting to do real damage to the insurance industry. Uh, in part because the insurance industry, first of all, the losses are greater, but also it's getting increasingly difficult for the industry to pass along the higher costs in the form of higher premiums. And we'll come back to the premiums, but they're because they're going up, but they may not be going up as fast as they need to compensate for the risks that the insurers are facing. Is that perception correct?
That's correct, and there's a lot of regionality to it, right? So depending on which state the carriers are operating, right? So for example, when you think of California, right? So California has a Proposition 103 that dates back to 1988, right? And what that means is you cannot, for example, include the cost of reinsurance in the pricing, right? So that's one element where
You cannot? You
you
cannot?
cannot. You cannot, for example, use catastrophe models to inform your loss cost that could be used for rate making, right? So
I see.
that's another one. So, when
Mm.
you look at, for example, if you want to put that in perspective, right? If you look at the average cost of insurance for a residential property, let's say for a 300K dwelling, right? You see that California is relatively, I would say, about maybe 35 to 40% lower than the average, right? Because insurance companies are not able to incorporate all these different elements, right? And they can't increase by a specific threshold more than 6.99% without a public hearing, right? So, and that has been changing now and under the new California Department of Insurance Sustainability Act. So they opened up the process to allow for using catastrophe models. So that is something that is new. And we're starting that process to review our Moody's RMS model there with them as well. So we're expecting things to sort of start to stabilize, but to put it in perspective, insurance carriers, for example, in California, they basically paid, to some of these latest wildfires more than 20 to 25% of underwriting profits because of all these extreme events. So, yeah.
And I'm here in Florida, and my experience here is that it's roughly the same kind of problem that we're getting hit, costs are rising, but the insurance industry is struggling to. Premiums are definitely going up, and there's a lot of denial of insurance. So insurers are becoming more circumspect and cautious about providing actual insurance. But despite that, the insurance industry hasn't been able to kind of keep up, and it's starting to weaken their viability. And the response so far has been to set up these government-backed insurance companies. I think here in Florida it's called Citizens. I think in California it's called, is it Fair? They call it Fair?
California Fair Plan, correct.
The Fair Plan. Um, so, uh, same kind of deal here in Florida too, and that's going on with California. Maybe not to the same degree, but the same kind of dynamic playing out.
Yeah,
Yeah.
absolutely. So, I would say one important measure, right, to evaluate the health of the insurance market is what we call these, through the lens, I would say, of the insurers of last resort, right, or the residual market, which means if I'm in California today, right, and my policy is not renewed, right, or I'm dropped from my carrier, then I go shop around. I can't find any other carrier that is willing to insure my property. Then I go to the California Fair Plan, which is essentially the last resort, right? Now, what we've been seeing, for example, in California, is a huge or growth in the California Fair Plan. So in 2018 or 2019, their exposure was only 50 billion US dollars. and now their exposure has grown to almost, I would say, $500 billion or even more, right? So it's almost 10x of growth in exposure, and of course, they're accumulating all that exposure in high risk areas, right? So that's the important part of it. But what's important also to note is the state, the California Fair Plan is essentially financially supported by admitted carriers that are licensed to write insurance in California, right? Which what it means is if they don't have enough money to cover the losses, they would assess the market, right?
Mm.
When they assess the market, the carriers that are admitted in the market would have to go pay based on their market share. So they just assessed the market 2 weeks ago by 1 billion. And now, they send the bill and the carriers that are admitted would have to pay within 30 days.
And do they pass that along to
They can
homeowners?
pass for the first 1 billion, they can pass 50% of it to the consumers. Yeah.
Right, right. So is it, I mean, when I'm thinking back to this past summer when what was the storm that was it Milton? I think it was Milton that hit the west coast of Florida, and if there was some discussion if it kind of went up Tampa Bay and hit downtown Tampa, the losses would have been so catastrophic that who knows, but the worry was that it would be so catastrophic that it would undermine Florida's insurance market. You'd see failure, that there would be failures. Is that overstating the case? Is the industry that fragile that if we get a major storm, hit Tampa Bay, that it could destabilize the insurance
It
markets to that
depends.
degree?
Yeah, I would say it depends, right? Because if you
Depends.
look at there's a huge growth, for example, in the Citizens, right? The Citizens of Florida, which is also another
Yep.
insurer of last resort. So it peaked in 2022 at about 1.4 million policies, right? So that could have been, and a lot of that risk is concentrated in these regions, right? That are vulnerable to hurricanes. But now we're seeing some sort of a drop, right? Because they're having all these programs essentially to offload these policies to the private market. So the way it
Mm,
works, right, is as the market starts to stabilize, you see more and more of these policies going back to the private market. One
mm,
thing maybe that's important to note here is, the flood insurance, right? Because
mm-hmm,
even with Citizens, right? With Citizens, you're essentially getting a wind insurance policy, right?
mm-hmm.
But now recently, they have some recent requirements following Hurricane Ian in 2022. And the requirement says if you want to maintain your Citizens policy, you have to also get a flood insurance policy, which is completely
Mm-hmm.
separate, right? It doesn't matter if you're in a flood zone or not. You have to obtain a flood insurance policy. So that's another one, right? So we're starting to see that dynamic of, more flood penetration or for more flood, I would say, uptake, and we're starting to also see that certain, I would say, consumers are starting to shop out to look for, other providers where they don't need to get a flood insurance policy, given there's no lender requirement.
I guess I'm looking to you to give me a warm, fuzzy feeling, Faraz. I mean, should I feel warm and fuzzy? I mean, push comes to shove, is the insurance market going to hang together, or should we be worried that there could be some kind of what's the word, crisis in these insurance markets? I mean, I know it depends, on the storms and the fires and the events and everything else, but given the direction we're headed here, that hockey stick you were talking about, is that something that we should be worried about? That, the viability of the insurance markets and the insurance industry, uh, is that something that you worry about, or are you going to give me a warm, fuzzy feeling about that?
No, I think, when I think about it, right, it's, when you look at the insurance market as a whole, right,
Yeah.
you have the carriers, right? So those are the primary carriers that, write these underwriting the policies. And then, of course, you have reinsurance, right? So global reinsurance companies. And then, of course, you have the element of the ILS or insured link security. So there's all these mechanisms, I would say, that allow the insurance market to continue to, I would say, to operate in these markets. Insurance is all about taking risk, right? And
Right.
there's really no bad risk. There's really bad pricing of that risk, right?
Bad pricing.
And I
Okay.
think that's the important
Yeah.
aspect because, in many of these regions, the rates are not aligned with the risk, right? So what we're
Yeah.
seeing here is we're starting to see that shift. I was reading a report that came out from the budget Senate committee, right? And
Uh-huh.
they reached out to all the carriers in the US and collected information about, okay, where are we seeing non-renewals, right? And they collected information for about, I would say, 65% of the market share. And you start seeing like, yeah, the non-renewals are essentially happening in these areas that are very vulnerable to risk from wildfire, from storm
Mm-hmm.
surge, from flood, right? So carriers are understanding the risk much better now, right? They can understand that, okay, this is an area that is at very high risk. What should I do about it? Or this is an area at very high risk, but they're investing in mitigation, right? Because remember, one of the biggest challenges is the aging infrastructure, right? You have aging levees, you have aging dams, you have, for example, aging utility infrastructure that could potentially, create some ignitions that could create wildfires. So that these are elements where insurance companies are better understanding the risk through the lens of, enhanced data or models, and they can understand, well, yeah, this is an area that was vulnerable, but now I see that, for example, the federal government or the state invested in a levee. You see downtown Manhattan, they're investing billions of dollars in seawalls and flood barriers. In Hoboken, portable flood barriers, right? Yeah, so the hazard is there, but we're also starting to build differently, right? And they're factoring in all that information when they look at the risk, right?
Okay. So my interpretation of what you're saying is we're adjusting. You know, all these different mechanisms are, the insurance industry and market are under stress because of
Yeah.
the reality of these storms and the costs. So it wouldn't be surprising that, there'd be stress, but the industry is adjusting in all these different ways. You mentioned kind of the reinsurance and the risk sharing through securities markets. You talked about the mitigation efforts to, make sure that communities that are more at risk for being hit by these things are in a better spot, improving the infrastructure, that kind of thing. That's what you're saying to me.
Yeah, exactly. Yeah,
Yeah.
yeah.
And I guess if at the end of the day, would you think if we got nailed by a, really catastrophic storm, a Cat 5 that went, right through Miami, I'm just making that up, but
Yeah.
that would be very expensive, obviously. Stress any kind of system. You would think the government would step in at that point and help out, you would think.
Yeah, it depends. Like, for example, when you think of, I mean, NFIP, right? The National Flood
Yeah.
Insurance Program,
Right.
they just took a big hit. They estimate that their, losses from Helene and Milton could reach 10 billion, right? So
Okay.
that is really, that puts it very high. That puts it equivalent to their losses with Harvey or Sandy, right? So they had to go borrow again from Treasury, right? They just borrowed $2 billion, and now their debt stands at about 22.5 billion US dollars, right? So
Mm,
every day they pay around $1.7 million just in interest to Treasury, right? So
mm,
it's going to depend on who gets that hit, right? So if it's NFIP, is it Citizens?
mhm,
Is it, I mean, the FAIR Plan just saw that in California,
mm,
right? So it's just going to depend. But one thing, that insurance companies look at is really diversification, right? Because really
mhm.
diversification is the name of the game here, right? It's yeah, where can you diversify the risk and spread it to make sure that you're not very exposed when an event like that happens.
Faraz, did you notice your co-author? He gave that kind of a skeptical look when I said the government would step in and help out here. Did misread you, Chris? I mean, that was a pretty. You look
Obvious.
skeptical.
I am skeptical.
Oh,
You know what happens Friday midnight
what?
if nothing
Government
NFIP
shutdown?
expires again?
The NFIP can't write
Yeah,
any policies.
Can't write any
yeah,
policies. So,
if it lapses, yeah,
and it's been this way for forever now, right? It's always touch and go.
yeah.
Um, so I don't know if we get hit by a big storm, right?
Mm.
Will there be sufficient interest to cover it, to provide support, right? This program, it's under FEMA. FEMA's also under the gun when it comes to
Yeah.
Doge and whatnot. So
Yeah.
I think at the end of the day, probably yes, they would step in, but I don't think there's any guarantee anymore.
Yeah. And I think maybe also an important element to highlight, right, is the element of insurance gap, right? Not everyone, for example, has flood insurance, right? Even if you, like Mark, you mentioned Tampa, right? If you go maybe 2 miles inland, you're talking about take-up rates, which means, how much,
Yeah.
policies are within a zip code of less than 5%, right? So which means 100 homes, you have maybe 5% that have flood insurance. When you look at Asheville, North Carolina, that area that got hit really bad. It's less than 1% of properties had flood insurance in that area, right? Which really means they're on their own, right? Now, flood possibly it depends on what kind of flooding that property gets hit by, right? If it's fluvial versus coastal storm surge, it's a completely different story. But generally, flood what we see is more of content damage, right? So if you look at NFIP, they had over the last 20, 30 years, they had 1.1 million claims, and they paid around 70 billion in losses. So you're talking about 65K to 70K on average for a claim. But when you talk about wildfire, you're talking about a full destruction, right? The whole property is gone, content is gone, everything is basically gone, right? So the size of the claim is completely different. And that's one thing that, we're, as we build these models, as we talk to the market, there's a huge difference between the peril, the type of destruction and so on. So, but with flood, we know there's a big insurance gap. But one thing I would say the California or the LA wildfires highlighted was also an insurance gap when it comes to fire, right? Because historically, really, who doesn't have wildfire insurance, right? And now when you look into, these areas in LA County, you see there was a lot of non-renewals, and you also see that there were many properties that went uninsured, which, because if you don't have a mortgage, there's no requirement for you to get insurance, right? So
Right.
essentially,
Right.
I've been living in this house for 30 years. I go to another carrier or to the fair plan. It's very expensive. I can't afford it. And I'm just going to go uninsured, right? So that there's the category or go underinsured. Yeah.
Undersure. Yeah.
Yeah.
Yeah. Well, it does feel like we're at some point, who knows when, we're going to get nailed by a bad event where it's going to test government, state government, federal government, whether you'll see, whether they stand up or not. I suspect ultimately they would, but it'll be a real test. Um, so that gets to the other way to adjust to all this, and that is to raise first, you deny service, if you don't think you can charge a premium if you're an insurance company that would cover the risk, but you also raise premium, and we're seeing premium increases to a very significant degree. I know, Chris, you follow that data pretty carefully, particularly on the homeowners insurance side. I know vehicle insurance is up too, and for lots of different reasons, also including, I think, climate damage, weather damage. But do you know, Chris, do you have any sense of the numbers in terms of the homeowners insurance premium increases?
Yeah, the data is a little bit hard to get, but I think one of the better data sources I've seen looking at actual mortgage records, so the fact that people have to escrow for insurance, I think it showed about a 14% increase, if I'm not mistaken, over the last year. So that's
14,
this
that's
is
nationwide.
nationwide. Yeah.
Homeowners insurance has gone up
Yeah.
14%.
Right.
Yeah.
And that's after, several years of double-digit increase.
Right.
So it continued
Right.
to rise.
And in terms of what, I always get confused. What does that really cover when it comes to weather events, the homeowners insurance? What does it cover exactly?
It generally covers the named storms. I was just looking at my policy last week, and I think I'm underinsured. I'm just looking
Oh
and I'm
no.
just telling my wife,
That's not a
no,
good
if something
sign.
happens, I don't think we can rebuild. Yeah, so it covers named storms.
Yes.
It
Okay.
covers severe convective storm because that's a big peril, right? Like severe convective storm, like this is a high frequency peril, right? And then it's causing a lot of issues And if it doesn't cover flood, right? And then after that, it depends on, how much, what coverage do you have? Is it standard content?
Hmm.
For example, how much of additional living expenses is covered in that policy? What's your deductible for a roof, right? There's all these different elements of it, I would say.
Hmm.
That's a great point as well. This number doesn't reflect the fact that you also have people who have, or homeowners in general, have been increasing their deductibles, right? So it's
Yeah,
Right.
paying
The
more
effective income.
insurance,
Yeah.
more in premium for less insurance, essentially. So there's another
yeah,
underinsurance piece of it.
yeah, yeah. But I think when you look at the four major subcomponents, right, which is the mortgage interest, the mortgage, primary balance, and then the property tax, insurance, on average, has been going up significantly higher than the other three components, right?
Yeah.
Well, I think that this is fuzzy in my mind, but there's a growing, not inconsequential and growing share of homes where the property tax plus the insurance is now more than the mortgage payment on the home, which
Yeah.
is
Crazy.
Yeah, yeah.
crazy.
I mean, even with NFIP, right? So NFIP, what they did, right? They went and revised their rates two years ago, right? And now, what's going to happen is for some of these rates to become, aligned with the risk, they could go up by 700, 800%, right? Because what's happening now is, if I'm in a flood zone, I'm subsidizing someone else if my property is not vulnerable to flood. I'll give you an example. Lee County in Florida, right? Now the average premium is 900, and I think it's $960, but that's expected to go up to almost 3,400 on average, right? But of
Wow.
course, it can go up immediately. They have,
Right.
it's more of like a
Staging.
right path, right? At 18%. So it will reach eventually by 2037, some of these areas would reach their full actuarial premium, right? So that's what's going on. Yeah, but
And
that's
you can,
NFIP.
and Chris, I know you've done work here as well on house prices. You can see it in house prices, right? Particularly, I mean, Lee County is a pretty good example because Southwest Florida, I believe, house prices are actually falling.
Yeah. Yeah, you're starting. It was a bit of a mystery during the pandemic years, right? Despite the fact that insurance had been going up and continued to go up, we hadn't seen a house price. We actually continued to see house prices rise faster, right? And I attribute that to the low interest rate environment, right? If you were able to kind of play off the fact that, okay, I have to pay more insurance, but I've got this great deal when it comes to the insurance, when it comes to the interest rate. Now that that's no longer the case, I think you are starting to see the homeowners reevaluate. Some folks on a fixed income are retiring in Florida, right? It just is not feasible anymore, so they're having to sell and move. And I think you'll continue to see this reveal itself in more and more markets as people realize the full cost of ownership, not just the mortgage rate itself, but the insurance premium. And as Firas said, it might moderate here, but it's still going to go up as the premiums catch up with the actual risk.
Yeah.
Well, I guess, and this sounds a little, I mean, green eye shade perspective. Doesn't this have to happen though? I mean, we are locating and living in places that are at real risk of getting nailed by climate events. And I mean, we've got to adjust, and this is the way it works. The cost goes up for living in those areas, and it pushes people out of those areas. It's very painful adjustment, but particularly for the families that are involved. But how else would it happen? I mean, I think, am I wrong? Is there any other way? I mean,
I
this
think,
seems there's other ways, but that seems like the most efficient way of doing it.
yeah, we've been looking a lot on these trends, right? So and we looked at it also globally, like a recent paper that the team published was looking at in terms of the growth of exposure in flood risk areas. And what we saw is really the population or growth in flood-prone areas has been, I would say, non-linearly exceeding the growth in non-flood-prone areas, right? And this is in North America, this is across the board, right? Which means that we're continuing to see expansion or urbanization in these flood-prone areas.
Oh,
Uh, no one would talk about it, in the past because yeah, it would flood, but there's no exposure there, right? So no one would report it. But eventually, now when you're continuing to build in it, and now yeah, now you're gonna see it all over the news how this area flooded. It never flooded before, and so you're seeing that dynamic, right? But at the same time, I think in coastal areas, we're starting to see a little bit of an reverse of that shift in that dynamic. The reason we're seeing that is when some of these properties are being impacted, when they rebuild, for example, they elevate, right? They have a higher first floor height, right? Or they build
uh-huh.
differently, right? And that is, the element of, I would say, resilience is, yeah, how can I rebuild and bounce back, but bounce back better to make sure I don't get impacted by some of these events that happened in the past or could possibly happen into the future, right? So that's the hazard is still there, but we're starting to see building code that is different, right? But there's a lot of confusion. Yeah, there's a lot of confusion in terms of, yeah, am I in a flood zone? Am I outside of a flood zone? Like I mean, I think I have a really interesting example in New York, right? So Sandy hits 2012, FEMA, right? Of course, FEMA is the agency that is
Yeah.
looking after these flood zones or flood boundaries, depending on the terminology. And they revised these flood zones and went back to New York City and said, okay, these are the updated FEMA flood zones. But now these updated FEMA flood zones are going to put hundreds of thousands of residents in now flood zones, which means now they have to get flood insurance. It's going to impact
Mm-hmm.
affordability, right? It's going to impact potentially the valuation of the properties.
Mm-hmm.
So the city appealed it, right? And they cited issues with the methodology. And yeah, there are uncertainties in the methodology. They won the appeal, I think, in 2015 or 2016, and it's still there. Like there's today,
Oh,
if I want to underwrite a policy in New York, the official FEMA flood zone map or the flood insurance rate map is based on 2007, which really dates back to the 70s, if you will, right?
right.
That's how we. But if you want to go build something in New York, they tell you have to look at the 2015 that they depending. You have to look at which one is more conservative, and you could possibly end up picking up the one that they appealed, right? So there's all that confusion if you're
Yeah.
taking flood insurance
Well,
versus if you're trying
actually,
to.
what you just said confused the hell out of me. So I
Yeah, exactly. It's
you
very
can leave
confusing.
it.
Like you could have two neighbors. One of them is
Yeah.
using the flood insurance rate map that goes back to 2007 or even prior to
Yeah.
that.
Yeah.
But the adjacent neighbor, if they want to pull like a permit or do a new reconstruction, they might end up using the 2015 that was appealed, right? So there's two maps out there. Yeah. And
Right.
it's still not unified. Yeah. So, but this is the dynamics the consumer is dealing with, right? So if we're confused, then the consumer is even confused further because there's
Yeah.
a risk of someone saying, "Oh, I'm not in a flood zone," and they would go and pay if they know that their property was vulnerable to flood, but it's giving them that false sense of security, right? Because the lender is telling them you don't need flood insurance. Like my neighbors in New Jersey with Ida, a lot of them flooded and the perception was, oh, we didn't know we needed flood insurance, or we're outside of a flood zone, so yeah, why would we flood, right? Or there's all that confusion.
Right. But just to make sure, we we would expect to see premiums continue to rise. That's almost written in stone now because in places like Florida, like Lee County, that's going to happen.
For NFIP, yeah, yeah,
Yeah.
there are
This
some areas that will drop though. Yeah,
Some areas will drop.
yeah, because some in the past, right, NFIP specifically would look at it from a binary perspective, right? So you're in a flood zone, right?
Oh, I see.
This is
I
the
see.
premium, right? But now you could be in a flood zone, but you're relatively elevated. So topography plays a very big role. First floor height plays a big role, right? But in the past, yeah, it's more of a peanut butter approach, right? Now it's different.
I see. But generally, we'll see higher premium that'll put pressure on prices. You'll see more self-insurance. You'll see adaptation in terms of how people build and building codes going higher, for example. But ultimately, that it sounds like populations are going to be incented to move away from uh, areas that are prone to natural disasters, or not?
Yeah, I mean, unless there is more investment in mitigation, right? And that is
Okay.
the
Okay.
mitigation is really the big one here, right? Because
Right.
that's the variable that can change everything, right? Because a lot of this risk can be mitigated, right? The way, when I think about it because I'm a hydrologist, I think of the upstream and I think of the downstream, right? Downstream is essentially we're always reacting to, okay, an event happened here. We're reacting in terms of event response, rebuilding, right? And so on. But if we move a little bit upstream and try to see, okay, what can I do to prevent an event from, if an event happens, how can I build better to make sure that these properties are not impacted, right? And that's really now the dynamic we're seeing in California. There's all this, you know, programs that does mechanical thinning, which means you basically do vegetation management to make sure that the fuel is not burning. You're doing utility companies and is investing a lot in hardening their infrastructure to make sure there's no ignitions, right, that are caused by their transmission or distribution lines, right? In terms of flood, we're seeing more and more investments in levees, more and more investment in enhancing stormwater systems, right? A lot of these systems were designed to absorb a limited, let's say, 1 or 2 inches of rainfall per hour, and we're seeing more than that. So we're seeing a lot of that investment in terms of how can I retrofit the built environment to allow me to, become more resilient when I have an event like that.
But even that, the mitigation has a cost, and presumably that means my property tax is going to go up, right? Because,
Yes.
right, I mean,
Yeah. Mitigation has a cost. Yeah.
it has a cost, right? Like in Miami, I've got seawater coming over every day. I got to put a seawall. That's expensive. That's going to be someone's got to bear the cost. It would be presumably the residents of Miami. So, Chris, do I have that right? Am I thinking about the because for us, we kind of look at it from the perspective, what does it mean for an economy where people
Right.
live, and what does it mean for house prices and commercial real estate values? And our thinking is that, this is going to put downward pressure on prices for CR commercial real estate and for property, residential property. Chris, do I have that right? I mean, is that
Yeah, that's right. The only other thing I might throw out there is that, these people have to go somewhere, right?
you have to go
So
somewhere? That's a good point.
we also have the issue of supply in other locations. And if zoning continues to restrict that supply, right,
Right.
that may actually force some people to continue to live in more riskier areas and just, they don't have another choice. So they're just going to roll the dice, right?
Yeah.
And see what happens because they don't have another option or it's not a feasible option, right? So that's another consideration. It always
Yeah.
comes back to zoning. Sorry.
Yeah, right, right, right. Well,
Mm,
I want to play the game.
yeah.
We'll end the conversation with that. Although Faraz, you were saying you're in London. You're at a conference with an insurance conference in London.
Yeah. Yeah.
So I
Exactly.
want to know. I've got this image of all these British insurance guys that what they do is at 4 o'clock they go out to the pub to drink a beer. Is that just my imagination, or is that have you been out drinking already with your
I
buddies?
know I've been like busy back-to-back meetings, and
Oh,
yeah,
okay, yeah, sure, for us. Yeah,
but I like London. It's fun.
I like London too. Yeah. All right, let's play the game. We each put forward a stat. The rest of the group tries to figure it out through clues, deductive reasoning, questions. The best one is not so easy, we get it immediately. One that's not so hard, we never get it. And if it's apropos to the topic at hand, which is pretty clear, all the better. And we always begin with Marissa. Marissa, you're up.
Okay, this is kind of a tangential topic. Okay, just throwing that out there. It's not directly related to what we're talking about here, but it's
Oh, okay.
tangential.
Tangential. Well, everything
Uh,
is tangential to this topic.
it could be directly related, but it's
Okay.
not. All
Okay.
right, this is a statistic that came out this week, and it's 89.7%, 90%.
90%. An economic statistic?
I'm rounding. Yep.
Is it survey based?
No,
Oh,
no.
okay. Uh, related. So but this is going to be a tough game because this is a tough topic.
Related to insurance and
Related to insurance? Probably not.
no.
No,
Inflation?
no.
Prices? No. Okay.
Is it
Uh,
related to tariffs?
Tangentially,
tangentially.
third order of magnitude related to inflation.
Well,
Is it a government statistic?
No, it's not.
is it NFIB survey
No,
related, which is a
no.
small business trade group? No. Um, 90%, you kind of rounded up 89.7 to 90%. Can you want to give us another hint?
This is a year-over-year growth rate
Ooh.
in an
Oh.
index that came out this week.
Oh, goodness gracious.
Oh,
Refinancing applications?
Yes.
Oh,
Wow.
nice.
Ah.
Yes.
Yeah.
Yeah.
As soon as I stopped thinking about insurance, that's the only chance I had.
Right. In so what go ahead, tell us
It's from the
what the
Mortgage
story is.
Bankers Association.
Yeah.
It came out this week on the number of
Yeah.
mortgage applications, and they break it down
Right.
into purchase applications and refis. And the number of refi applications is up 90% over the year.
Wow.
So
From zero to something, but okay.
but I actually wasn't even going to pick that. I was just going to pick the total composite index is up a third over the year. People really loving this 6.7% mortgage rate, I guess.
Right. Well, I guess you're saying it's tangentially related because when people refi, some take cash
Housing,
out.
housing.
Housing. Okay. 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 Very good. Um, what do you think, Chris? Anything to
That
say?
was
it's a
that was
lot.
right up Chris's
He's
alley.
he's kind of disappointed that he didn't
It's
get
a
it.
He probably wanted to pick
little
it.
bit, little bit. Yeah, it's off a low base, right? So
Yeah,
refis
yeah.
have been in the doldrum. So
It's like home equity borrowing, right? Home equity borrowing is up a lot, not 90%, but it up
yeah,
strongly, but it's up from like very low levels, very low levels. So, but
Yes, this is a related
yeah,
statistic to that, I
related.
would say,
Yeah,
you know.
yeah, interesting. Well,
yeah,
you could use a home equity loan to, mitigate,
Yeah.
raise,
Rebuild,
rebuild.
rebuild your home that insurance won't pay for. Sure.
Right. Exactly. Yeah.
build that seawall. Yeah.
Yeah.
That's build that seawall. Yeah. Okay. Matt, you're up. What's your stat?
Okay. Marissa was tangential. This is just
In left
risk.
field.
Yeah, left field, just risk broadly. We could probably
Risk.
throw
Okay.
in.
Risk.
Okay.
Okay.
-4%.
-4%. Inflation related?
Of course.
Oh,
Oh, something's down 4% in the CPI report, Consumer
Yes.
Price Index.
Year over year,
No.
month
I
over month.
saw airline fares were down 4%.
That's it.
yeah,
That's
yeah.
it. Yeah.
Oh,
Fries. Do you see how this is done?
Yeah, I
I'm just
love
saying.
it.
masterful.
Yeah.
Only when I get it. Yes. Okay. You want to explain?
Interesting week. Delta's earnings call got a lot of attention. Their CEO reported some pullback in consumer demand. That
Right.
is a pretty clear indicator of just, economic cyclical demand. Tracking TSA throughput is a government daily data point that's released that we track in bank. I look at that. You compare it today to this time last year. There's starting to be a little bit of a deviation, a pullback after tracking pretty closely through 2024. This year, tracking closely with 2024. Seeing some pullback. Also, some international flight data came out. We're seeing the first year-over-year decline in February since the pandemic. The decline is very slight, but kind of all pointing in the same direction, corroborating data there that people are pulling back on vacations. Maybe it's a little bit of business travel. Is it economic insecurity? Is it or economic uncertainty, or is it pretty gruesome plane crash a few months ago? Are people dialing back their willingness to go fly? So find it interesting.
Very
Could be an
interesting. Yeah.
early indicator. Yeah.
Watch that very carefully.
Yeah. Risk, as I said. So you might be waiting for the tie-in, but there is none coming. That was
a good one. No, that was a
okay.
good one. Yeah, in the context of all the things that are going on. Hey, Faraj, you want to go next?
Yeah, I'll go next. 2%.
2%.
Insurance related?
Insurance related, yeah, for a specific peril.
For a specific peril. So it's an increase in insurance premiums for a certain peril?
It's not an increase. It's what, you know,
Oh,
it's
2%.
share.
Oh, 2% of
only
cost
2%.
losses
Maybe
are from this peril.
uh, I would
Coverage
say
rate?
only 2% have it.
Oh, 2%
Oh,
have.
Percent of
Oh, okay. A
Of a
form
specific state.
have insurance. 2% of households have this form of insurance for this.
Yes, in a specific state. Yeah.
Florida flood insurance?
Uh, California. It's in California. That's the
California wildfire? Is that even a thing?
You're close, but it's not
Earthquake.
wildfire.
Earthquake insurance.
Oh, earthquake.
No, it's not earthquake.
Oh,
A little bit. Earthquake is a little bit more than 2%. Yeah.
A little bit more. Uh, I want to say termites. No.
It's related to climate peril. So
Oh,
we were
okay.
talking about
I was
that
being
peril.
flip. I was being flip. Uh, it, what could that be? It's not wildfires.
Fire, not earthquake.
It's not
Think
fire.
about
It's
you.
not earthquake.
Um, oh, it's got to be something very.
mudslides.
No, not
Isn't that,
mudslides.
does insurance get tornadoes?
We
No.
were just talking about that peril.
Oh, okay. We give up. What is it?
It's flood. Only 2% of
Oh,
properties
flood. Oh,
have
yeah. We
Oh,
Oh,
NFIP
she
flood
said,
say
insurance.
flood.
yeah.
Oh,
Yeah.
yeah. Well, yes.
Yeah.
Matt, I'm surprised you didn't say flood. What the heck?
I thought Marissa covered it, but I might have misheard.
well, I said
Florida.
flood was the
You said
first thing I
Florida
said,
and
but
flood.
it's
Oh, you
Okay.
said
Florida.
flood, so
Yeah.
I couldn't hear it then. Yeah, sorry about that.
I'm glad somebody. I was about to say El Nino, so I'm glad this was a horrible guess. So I'm glad you
Oh.
stopped before that.
Oh, you said flood, so I didn't hear it. Sorry.
Focus.
Uh,
Yeah.
oh, wow.
Yeah.
2% of California households have flood insurance.
On NFIP, yes. Yeah.
Oh,
NFIP
NFIP.
insurance. Yeah.
NFIP.
Yeah.
Okay.
Yeah.
Oh,
And
interesting.
only 4% of the areas that are vulnerable to wildfire has flood insurance, which is a bit concerning because, generally when an area is impacted by
Yeah.
wildfire, it becomes more vulnerable to flood, right?
Right. Right. Oh, interesting. Well, do you know offhand which state has the highest share of that
Yeah,
has
it's Florida, of course. They have
Florida
35% of the NFIP policies are concentrated in
in
Florida.
Florida?
Yeah.
Right. Right. Yeah, good. All right, well, let's do one more. Chris, you're up.
Okay, $6,200.
Some form of insurance premium.
Yep.
That's the insurance cost, homeowners insurance cost in a
In
state, Louisiana.
uh,
Florida.
let's get more narrow. A city.
Oh, a
New
city,
Orleans.
Baton
City.
Rouge.
Oh,
New Orleans
New
is
Orleans. New
New
Orleans.
Orleans.
that's 5,700. That's second.
Miami.
Miami is number one.
Oh.
That's the
Oh, is it
average.
Miami is
really?
number one.
Miami's that high?
Yeah,
average.
Wow.
Miami is very high.
I didn't know that. Wow.
Yeah.
That's a good stat. Where's the lowest, Chris? Do you know?
Oh, I used to know. It was it
I
used
think
to
it
be
used to be
Hawaii.
Hawaii, but I wonder
I
if that's the
remember Hawaii
case.
was low, but I think that's changed now
Yeah, it
because
must be
That seems counterintuitive that
because of
would
that
be.
wildfire. Yeah.
Yeah.
Yeah. Anyway,
they don't have many perils. So, but now they do, even wildfires, right?
Yeah.
even wildfires. Right. Well, very good. Well, I think I don't have a stat, so I'm derelict, but I think that we covered it. Is there anything I missed, Faraz, that that you would like to call out that you think is important? Did we cover all the bases here? Chris, anything that you think I missed?
I don't know if you wanted to talk at all about the so-called social inflation. I think part of the reason why the premiums may actually stabilize a bit or not grow as quickly is that you do have measures to deal with litigation. Litigation had been a big driver of a lot of the insurance premium increase. And I think in Florida now there are laws that are preventing or reducing some of that, nuisance lawsuit, let's call it.
Oh, I see.
So I don't know, Faraz, if you have looked at that at all, or what fraction of the increase do you think has been due to kind of social inflation versus
Yeah,
actual?
it's relatively high, right? The cost of reconstruction is always a big driver, right? And when we look at it from a insured loss estimate, we factor that into our estimates, right? For example, when we looked at California wildfires, right? We looked into, for example, what would happen if California potentially decides to accelerate, let's say, the reconstruction, because now you have some major international events happening. You have the FIFA soccer or World Cup happening next year. 8 games are being played close to that, 30 minutes away from the wildfires. You have the Super Bowl in 2027. You have the Olympics in 2028. So those are elements we call them, a demand surge, which means like, is there going to be more demand that could increase the reconstruction prices, right? So that is one important element. We look into historical information to trend some of our social inflation factors that go into the to the estimates, right? But there are, of course, this reconstruction is going to take years, right? So we don't know what could happen potentially with the lumber prices, if there are tariffs and so on. So that's another important element to keep in mind.
Okay. But if we do expect to see fewer lawsuits, right, because of some of the
In Florida,
too,
yeah,
right? Do you
because there
expect
has
that
been,
will
yeah,
help to keep premiums from rising at a accelerated
exactly.
pace?
And in Florida specifically, right?
Yeah.
Because the element of assignment of benefits and lawsuits now has, there's legislation that, protects insurance companies from that. Then that, of course, that's favorable, I would say, regulatory requirement allowed now, citizens to offload some of these policies to the private market, right? Because, citizens peaked at 1.4 million policies in 2022, and now it's at about 800K. So we're seeing that market stabilize, and part of it is because of this reform that allows more carriers to come back to the market.
Well, we're adjusting. It's not fun. It's not, and hopefully we adjust fast because it feels like we need to, but we're in the process and you're doing all this great work to help with that adjustment. So thank you for that. And want to thank you for joining us, Faraz. Really appreciate you spending the time. I know it's late in London. And go enjoy I was going to say go enjoy a beer, but at this point, maybe you need a cocktail. I don't know. But
Yeah,
yeah,
yeah, I'll find something.
you'll find something. Very good. And with that, dear listener, we're going to call it a podcast. Take care now.